What is good, YouTube family? Back with another reality check that is probably going to hurt some feelings. Now, I've been seeing you in the comments asking why your £500 account isn't growing after 6 months of profitable trading. Today, I'm exposing the uncomfortable truth about why small accounts stay small and it's not what you think it is. Now, listen, I've been exactly where you are. I started my trading account with £300 thinking I would turn it to 5 figures within a year. I was even calculating how many trades it would take to hit my first 1,000. I was risking 15 to 20% on each trade because anything less felt like I wasn't making real progress. I watched that account get wiped 3 different times before I finally understood what I'm about to share with you. The problem isn't your strategy, it's not your broker, and it's not the market manipulations you keep blaming. It's your relationship with small money and the psychological traps that come with it. If you've ever caught yourself thinking it's only £50 I can afford to lose it, or I need bigger positions to make meaningful profits, this video is specifically for you. We're about to dive into why that small account has become your financial prison instead of your launching pad. Here's what's really happening when you trade a small account and why most of you are stuck in an endless cycle without actually realizing it. Smaller account traders fall into what I call the lottery ticket mentality. Because the dollar amounts feel insignificant, you start taking risks that you would never take with larger capital. You convince yourself that losing $50 doesn't matter, so you start risking 10 to 15% per trade, chasing those big percentage gains that you see other traders posting on social media. Here's the mathematical reality which is destroying your progress. If you're risking 10% per trade on your account and you lose 5 trades in a row, you have cut your account in half. Just 5 trades. And in trading, going on a 5 trade losing streak happens more frequently than you think, especially when you're not following proper risk management. The psychology gets even worse. When your account drops from $500 to $250, you start feeling desperate. Now you're not just trading to grow, you're trading to recover. This desperation leads to revenge trading, over trading, and higher risk per trade because you think you need to make it back fast. This is exactly how your account goes from $250 and becomes $100, then boom, before you know it, your account is blown. You're focused on all the wrong metrics. You're celebrating a 50 pip winner that made you $25, not realizing that on a properly sized account, that same trade setup could have made you $250 or even $2,500. You're thinking in pips instead of percentages, in small amounts instead of long-term wealth building. But here's how you break the cycle. You need to completely reframe what success looks like on a small account. Stop trying to turn $500 to $5,000 in 6 months. Start focusing on turning $500 to $600 and $600 to $700. Master the psychology of consistent growth before you worry about explosive growth. Traders who successfully grow their small account understand that the size of their account isn't their limitation, their mindset is. They treat their $500 like it's $50,000 in terms of risk management and discipline. They know the habits that they build when they have small money will determine their success when they have larger capital. Let me break down the framework that separates small account traders who stay stuck from those who actually go on to build wealth. Number 1 is proper position sizing for growth. First, forget everything you think you know about risk per trade. For accounts that are under $1,000, you should never risk more than 1 to 2% per trade, even if the dollar amount feels small. Yes, that means risking $5 to $10 on a $500 account per trade. I know this feels insignificant, but this is where discipline begins. Here's why this matters. A trader that's risking 2% on their account per trade can survive 30 consecutive losses in a row and still have money to trade on their account. A trader that's risking 10% per trade is broke after 10 losses. Which trader do you think has better long-term survival odds? Number 2 is the small account compounding strategy. Stop thinking of monthly gains and start thinking of quarterly. A small account which grows 5% consistently per month will outperform an account which grows 50% in 1 month but loses 40% the next. Consistency beats volatility every single time. Track your trading progress in percentages, not dollars. A 3% gain on a $500 account is exactly the same skill demonstration as a 3% gain on a $50,000 account. The only difference is the dollar amount, but the trading skill on show is identical. Number 3 is realistic profit expectations. Now here's the reality check that nobody wants to hear. A consistently profitable trader is making 10 to 20% per month on average. not 100 to 200%. If you're expecting to double your account per month, you're setting yourself up for gambling behavior. Set milestone goals. First, you want to make $100 in profit. Then you want to make $250, and then you want to make $500. Celebrate these achievements because they represent real skill development, not just lucky trades. Number 4 is the psychology of trading small capital versus large capital. The biggest psychological trap with small accounts is the monopoly money effect. Because the amounts feel small, you don't develop proper respect for risk management. This casual attitude becomes a deeply ingrained habit that destroys traders even when they get larger accounts. Start practicing the psychology of larger capital now. Before every trade, ask yourself, if this was $5,000 instead of $50,000, would I still take this trade with this position size? This mental exercise will build the discipline you need as your account grows. Number 5, building the foundation of wealth. Understand that your small account isn't just practice money, it is your trading education fund. Every dollar you lose to poor risk management is a dollar you cannot compound later. Every bad habit that you form with small money will amplify with larger capital. Focus on developing these 3 skills above all else: consistent entry criteria, disciplined position sizing, and emotional control during losses. Master these things with small accounts and scaling up becomes natural. Now, if that just opened your eyes to why your small account isn't growing, I want you to do something right now. Calculate your risk per trade from your last 10 trades and drop the percentage in the comments below. I guarantee more of you are risking way more than you should be. Let me tell you something that took me 3 blown accounts to understand. Your small account isn't your problem. Your small account thinking is your problem. I spent 2 years frustrated with small accounts, comparing myself to traders posting 5-figure gains, feeling like I was moving in slow motion whilst everyone else seemed to be getting rich. I kept telling myself, once I get a bigger account, I'll trade properly. That was the lie that kept me broke. My breakthrough came when I finally accepted that my small account was my trading university. Every trade was tuition paid towards my education. Every loss that I took due to poor risk management was an expensive lesson that I had to learn with small money rather than large amounts of capital. Here's what I wish someone had told me when I had started trading. The trader that can consistently grow their account from $500 to $1,000 has the exact same skills as the trader who can grow their account from $50,000 to $100,000. The only difference is capital, but the discipline, the patience, and the risk management are identical. Stop treating your small account like a lottery ticket where you need to hit the jackpot to make it worthwhile. Start treating it like the foundation of your trading empire. Every good habit you build now will pay dividends when you're managing 6 or 7-figure accounts. The traders you admire, the ones that are posting big profits, they all started exactly where you are now. The difference isn't talent, it isn't luck, and it isn't access to better strategies. The difference is they learned to respect small money, so the market trusted them with larger amounts. Your $500 account isn't too small to build wealth. It's the perfect size to build the skills that create wealth. Stop trying to escape your small account and start trying to master it, because I promise you this, if you cannot make consistent profits with $500 in your account, giving you $5,000 will not solve your problems, it will just make them more expensive. Hit that like button if you've been treating your small account like a lottery ticket. Drop foundation first in the comments and I will send you the link to my free community to build real trading discipline. Guys, I'm here to help you make the transitional shift. Remember, once you've learned the skill set and you actually understand the discipline required, you can go from trading small accounts to larger amounts of capitals and it will not faze you. Remember guys, you shouldn't be in a rush to go from small amounts to big amounts if you cannot consistently grow your account. It's going to be more expensive and the pain is going to hurt a lot more once you start trading larger amounts of capital. I hope this video helps. I'll see you guys on the next one. Thank you for watching the latest episode. If you like that, please like and subscribe to my YouTube channel for more content. I'll see you on the next video.